We saw the markets down like 6%. I mean, people here in the U.S. thought that we were going to follow suit, but nothing doing. I mean, and we have to remember that the China market has rebounded quite well over the past few weeks. 6% is a gigantic move, but yeah, it's really based on nothing but perhaps an air pocket in the market. The fundamentals really haven't changed a whole lot.
As you say, despite everything that's happened, markets really still haven't moved much. I mean, it's been a very active year of those macro and micro events, but everything really is netted out to be neutral.
Yeah, it's a good point. And, a lot of people are expecting this this next big move, and maybe we'll have it. But, we've been sitting within 1% of unchanged for the last 7 months, and sometimes that's a good thing. It's a good consolidation stage where the market works off excesses, rebalances itself, and makes that next move. But, yeah, the thing what I've noticed is that the market, the sentiment's not very good. However, it cannot sustain any weakness. So very fascinating to watch, even though it's not doing a whole lot.
Larry, I suppose also worth noting that despite, that sideways movement in the markets, it hasn't exactly been pain-free, and there's been a number of those big important sectors and stocks that really have experienced some of those severe sell-offs. So take us through where really we've seen some of that, sort of weakness.
Yeah, just think about energy sectors, semiconductors, manufacturing, mining, industrials. They have just gotten hit so hard. And when you look really deep into the S&P 500, you'll notice that Google is worth 9 points to the S&P right now. Amazon 9 points, Netflix 3 points, Facebook 3.5 points. So you have a very, very thinning leadership, and to me that's always concerning. Especially when you have big groups of stocks not doing very well, the ones I just mentioned.
Larry, those Fed minutes being released tomorrow afternoon in the US, that's going to really be a key event, I suppose, for markets this week. No doubt investors will be looking, I suppose, for clarity around the language, but we also need to keep in mind that that meeting took place prior to all the recent turmoil in China.
Yeah, exactly. And, I think right now the market is just anticipating September liftoff. At this point, perpetual zero interest rate policy is counterproductive. It's a big headwind to the market. We also have to keep in mind that in the U.S., we'll see those minutes tomorrow. Those minutes will probably be fairly hawkish because it talked about a September liftoff or the potential for one. But we have to keep in mind that those minutes came out before most of that macro turmoil that we witnessed in China. So at the end of the day, I just don't think it's going to be a big deal. I think all eyes right now are on September the 4th, the next labor report, and after that liftoff on the 16th.
Do you think, Larry, that the Fed does need to hike those rates and we need to see liftoff in order for the market to break up and out of this month-long range? I mean, I suppose with liftoff potentially in September, as you do suggest, we may be getting pretty close to that scenario.
Yeah, I really do. I mean, I think the market's on hold, just waiting for that. And as I just said, I think it would be counterproductive not to raise rates at this point. What's the difference between 0.25% and 0.25% and 0.5% in the scheme of things? It would, if nothing else, the Fed would be signaling to the market that the worst is behind us and we're going in the right direction, and that's putting a value on money.
Larry, have you made any changes to your asset allocation as a result of the turmoil in China and obviously the yuan's depreciation and I suppose the impact on those current, oil price forecasts as well?
Yeah, I really haven't made any changes. I've just reiterated what I've said for the past 3 or 4 months, and that is emerging markets with the capital outflows, not just China. It worries me. I think it's really hard to pick stocks there. So I'm very severely underweight emerging markets in general, especially Asian emerging markets. And maybe a little bit more overweight in European equities, just thinking the macro, the flow of capital is going in that direction, and keeping a little bit, a small overweight in the U.S., but far behind European equities right now.
With a substantially more flexible and market-driven exchange rate regime in China, Larry, do you forecast further depreciation in that renminbi? I suppose that is the big question that everyone's asking.
Yeah, you know, when I look at like the larger commodity markets, the base metal markets, it just makes me think that it's pricing in the fact that the RMB is going to be devalued, but probably by another 3% at the end of the year, perhaps another 5% in 2016, slowly bringing it down to normalcy, and also appeasing the IMF. We have to remember that. I don't think it's a bad thing. I don't think it's going to turn manufacturing around right away, but I do believe if you look at commodity prices, it's kind of telling you the secret that we're going to see continued devaluation of the RMB.